Before I begin this topic, I want to put a quick disclaimer that I am not a financial advisor, and the content within this video is for educational and entertainment purposes only. If you need tailored financial advice, then please contact your professionally licensed financial planner. Always do your own research before investing any money into an asset and determine if it's right for you. Today, I will provide you a deep dive on being successful in ETF investing. First key is to understand what ETFs are. ETF stands for exchange-traded funds. They are investment funds traded on stock exchanges. They are a low-cost way to earn a return on investment similar to an index or commodity. It helps you to diversify your asset allocations across multiple industries as you are essentially purchasing a basket of shares or assets on a single trade. You will find many ETFs listed on the Australian Securities Exchange, or known as ASX. When you purchase the ETF, you won't own the underlying investment. You only own the units within the ETF, but the ETF provider retains ownership of the shares or assets. There are a few types of ETFs, and these are passively managed ETFs. This is the most commonly traded type of ETF in Australia. Passive investments don't try to outperform the market. Instead, its primary role is to track the value of an index, for example, ASX 200 or S&P 500. It may also track a specific commodity, such as spot price of physical gold. The value of the ETF may fluctuate up and down based on the index they are tracking. Being passive and no active fund manager means the overall management fees for these ETFs are generally lower. Another type of ETF is an active ETF, or hedge fund. Exchange-traded managed funds, also known as active ETFs, and hedge funds are actively managed by a fund manager. Being actively managed means management fees attract a higher premium and generally utilize higher risk trading strategies in an attempt to outperform an index. Another type is physically backed and synthetic ETFs. Physically backed ETF will invest into all securities in the index. It is essentially physically held ETF. The ETF fund actually owns the asset of the index it tracks. For example, a physically backed gold ETF will hold physical gold bars in a secure storage. A physically backed stock ETF will hold the underlying stock of the index it follows. Synthetic ETF holds some of the underlying assets and use derivatives to copy the movements of an index or asset. Synthetic ETFs attract additional risk that the counterparty, usually a bank, to the derivative could fail. There are a variety of asset classes and individual assets that are available to be purchased on the ASX. These include Australian shares, international shared, sectors such as financial or mining industries, foreign currencies, cryptocurrencies, and commodities. The great thing about ETFs is you get the desirable benefit of diversification. It allows you to buy a basket of shares in a single trade. ETFs enable you access to markets that can be difficult or expensive to access. Your risk is spread across multiple industries or sectors, meaning your money is not reliant in a single industry. ETFs provide transparency. They publish the net asset value, or NAV, daily. This helps investors track how the underlying asset is performing and if the price of the ETF is close to the NAV. Most ETFs show what assets are allocated to the fund, so you can see which companies the ETF is invested in. Most ETFs attract a low management to expense ratio, or MER. They are much cheaper than an actively managed fund. You can easily buy and sell ETFs during trading hours, and within 1 to 2 business days is settlement. So if cash is required quick, it is quite a liquid asset to hold. Aside from all of the benefits you get investing into ETFs, there are always cons involved. Important to know these when you assess if an ETF is fit for your investing portfolio and strategy. Market or sector risks. If an ETF is heavily reliant on a single industry, the overall value of the ETF may fall in value if that sector is underperforming the rest of the market. For example, if your ETF you invest into tracks the ASX 200, and if the ASX 200 is currently in a decline due to unforeseen economic downturns, then the overall value of the ETF will drop too. Currency risks. If the ETF invests into international assets, then there are risks of currency movements that may impact the value of the ETF, thus your ROI. If you invest in an ETF where the currency is currency hedged, then this risk is not applicable. Tracking errors. An ETF return may differ from the index it is trying to track. This may be due to the differences in the assets owned by the ETF and the index it is designed to track, fees and taxes. How to determine which ETF is best for me. This question is best answered by doing your own research. Now that I have taught you what an ETF is and the different types of ETFs that exist and its pros and cons, you can now do some research on performances of some ETFs. When you go on the website of an ETF provider, such as Vanguard, BlackRock, BetaShares, GlobalX, etc., you can see how each ETF have performed in the last 1, 3, 5, 10 years, and since inception. Have a look at what assets and companies are included in the ETF you are researching. Look at the management fees and track error of the fund. The least discrepancy of tracking error means its value is aligned with the index it is tracking. Consider the total cost of the ETF, its structure, and how often you want to purchase it at what amount. Utilizing the dollar cost average or DCA strategy is the most simple, passive, and ideal way to invest into ETFs. This is because you are utilizing the set and forget method of investing. You will let it compound over many years as you continue to add your own capital into the ETF within your portfolio. Set up a certain amount to be debited from your bank account into your cash account of your investment broker platform. Then set up an automatic investment in your broker platform to invest the funds into an ETF of your choosing. Set this up in ongoing frequency of weekly or fortnightly, whichever is best for your circumstances. This is the way I have done it, and it is working wonders for me, as I can set and forget. Also, it does not matter what the current share price is at the time you invest. What matters is over time you will spread your risks apart and minimize market volatility, leading to a higher overall return on investment. DCA strategy also encourages disciplined investing. This is a good habit to develop as it is much more efficient and lowers stress levels when investing. It develops emotional discipline, as markets may trigger emotional responses such as selling just because the share price dips 1%. Fear is taken out of the equation when you DCA, as you don't see the share price. You know you are in it for the long run, so you can take short-term pain in order to receive long-term gains. ETFs are designed for long-term holds. Long-term investors enjoy holding ETFs due to its diversified portfolio and asset allocation. This makes it great to hold for extended period of time. It is ideal to rebalance the overall portfolio. Regularly review and rebalance the portfolio to ensure it remains aligned with your investment goals, strategy, and risk tolerance. To mitigate risk, you need to adopt good risk management practices. This includes understanding the risks involved. These risks I have discussed earlier in this video. Please rewind it back to the potential ETF risks if you missed it. Then you need to diversify your portfolio. Look into various sectors such as information technology, mining, financial services, and among others. Research into long-term solid companies within sectors and is performing well. You may go deep and look at individual companies in the ETF and assess their profit-loss statements and overall financial performance. Understanding this part of ETFs can give you better informed decisions. You may put in place a stop-loss order. Broker platforms may offer this service, and it's essentially putting in an order to instruct the broker to sell your security at a specified price. This strategy is used to minimize potential losses on a trade by automatically exiting if the share price moves too low. Set yourself clear investment goals. You need to specify and define your investment goals and strategy. What do you hope to achieve in your investment journey? Assess your risk tolerance to guide your ETF investing journey. Regularly review your ETF investments and adjust your portfolio as needed to ensure it remains aligned with your goals. Always think long-term when investing in this asset class. There are hundreds, if not thousands, of different ETFs available to be traded on the ASX. Find out which fits best with your goals and values when it comes to investing your capital. It is a big decision, but investing in the right one will ensure long-term prosperity for the years to come. You need to make your money work hard for you instead of you working hard for money. Every decision you make must be conducive to your goals. This will empower you to get ahead financially and be on the path to prosperity. So, what's your next step? Let me know in the comments. Don't forget to like this video, subscribe for more content like this, and share it with someone who's ready to level up their financial game.